Welcome to the deep dive. Today, we're really peeling back the layers on Amazon's latest earnings report.
Yeah, going beyond just the headlines.
Exactly. Because with a company this big, the numbers, well, they always hide deeper stories, don't they?
For sure.
Our mission here is to figure out what's really going on, looking at, the good, the bad, and the ugly from the source material you shared. So you'll hopefully walk away with a quick but thorough understanding of Amazon's performance, investor reactions, what it means for them going forward.
And without getting lost in all the jargon.
Hopefully. Because even with strong numbers, there are always these deeper currents. Okay, let's jump in.
Let's go.
So coming into this report, there was quite a bit of chatter about market headwinds, right? But Amazon actually, well, they pulled off quite a surprise.
They really did.
Let's start there. What went unexpectedly right for them? Can you help unpack those core positive numbers?
Absolutely. So the headline figures, they definitely look strong. Revenue came in at $167.7 billion, which is a pretty robust 13% increase year over year. And, that significantly beat the consensus analysts were looking for around $162 billion.
Okay, so a solid beat there.
Yeah, and it even got a little boost, about $1.5 billion from favorable foreign exchange effects.
Ah, right.
And on the earnings per share, the EPS side, they reported $1.68 per share JAP basis.
Okay.
That's up a huge 33% year over year. And again, well above the $1.33 forecast.
33% is quite a jump.
It is. And operating income, also strong, $19.2 billion, up 31% year over year. And you saw solid performance across the segments.
Like North America International.
Exactly. North America brought in $7.5 billion, international $1.5 billion, and then AWS, their cloud unit, added $10.16 billion to that operating income.
Okay, those are definitely robust numbers. Revenue beat, EPS beat. Pretty impressive on the surface.
Yeah.
But, it's rarely just about those raw figures. What were the underlying business highlights that really powered these results? What should we be paying close attention to underneath that? Here's where it gets really interesting.
Yeah, definitely. I think beyond those top-line numbers, the accelerating retail growth is a really big story.
Retail. Okay.
Yeah, their online stores grew by 11%, third-party seller services also up 11%, and subscription services like Prime grew 12%.
So consistent double-digit growth across the board there.
Right. And this isn't just, numbers on a page. It suggests Amazon's strategy to optimize fulfillment costs and maybe recapture some market share after a tougher period. Well, it seems to be working.
So the core e-commerce engine is firing again.
It looks like it. And then advertising. Wow, that was the real standout.
Exactly. How did that do?
It absolutely soared, up 22% year over year, hit $15.7 billion.
$15.7 billion just from ads.
Just from ads. It shows how well they're leveraging that massive user base. It's becoming a huge profitable business for them, really diversifying beyond just retail and cloud.
Yeah, that's incredible growth.
It really is. What's fascinating here is it's just a sign of strength and momentum across their pretty diverse portfolio.
Okay, so that's the good. Strong core performance, advertising booming. But, as we always say, even the best reports have a flip side, right?
Always.
And for Amazon, it seems those strong numbers might be masking some emerging concerns, particularly in an area many expected them to just dominate. Let's unpack the bad news from this report, starting with the cloud business, AWS.
Indeed. That was probably the primary concern for many analysts and investors, the slowdown in AWS growth.
Slowdown, how much?
Well, AWS revenue was up, a respectable 17 to 17.5%, and that was actually slightly above consensus.
Okay, so still growing strong and beat estimates. What's the problem?
The problem is context. It was notably slower than its key competitors. Microsoft Azure grew at 39%.
Whoa, okay. Big difference.
Yeah, and Google Cloud grew at 32%.
Right.
So this raises an important question. Why is Amazon's cloud growth lagging? Especially now with this whole AI boom driving cloud demand. Is it just a blip or something more fundamental?
That's a key question, definitely. And it wasn't just the cloud growth rate that raised eyebrows, was it? The sources also highlighted a major concern about free cash flow.
Yes, absolutely. That was another big one.
That sounds pretty critical for financial health.
It is. Free cash flow is, basically the cash a company has left after paying for everything it needs to run and grow. Super important indicator.
And what happened there?
Well, their trailing 12-month free cash flow fell quite dramatically, down to $18.2 billion. from about $53 billion the year before.
Wow, okay, that's a drop of roughly 66%.
Exactly. A
Yeah.
huge drop. And the reason, it ties directly back to their very expensive capital investments, their CapEx.
We'll come back to that CapEx for sure. But first, just to round out the AWS picture. Slower growth, yes. But how did profitability look within AWS? Did margins hold up?
There was some pressure there, too. AWS operating margin dropped slightly, down to about 32.9%.
And why was that?
A couple of main factors mentioned. One was increased spending on AI infrastructure, building out the capacity for all these new AI models and services.
Makes sense. Need to invest there.
Right. And the other was higher stock-based compensation for employees within AWS.
Okay, so pressure on growth and margins in the cloud division. So you've got this, split picture, right? Really strong headline numbers, retail looking good, ads booming, but then these sort of shadows lurking with AWS growth and this big drop in free cash flow.
Precisely. A mixed bag.
The real question then is, how did the market, which, let's be honest, is often a fickle beast, how did it react to all this? Let's dive into the ugly part, the investor reaction.
Well, the market reaction was pretty swift and negative.
Yeah.
AMZN shares dropped about 8%, almost immediately after the earnings came out.
8%?
Yeah.
Even with those top and bottom line beats?
Even with the beats, investors were clearly spooked.
By what specifically? Was it just the AWS slowdown?
That was a big part of it, for sure, that cloud lag.
Right.
But maybe even more importantly, the company gave kind of muted operating guidance for the next quarter, Q3.
The outlook. What did they guide?
Their own projection for Q3 operating income was around $18 billion, but analysts had been expecting something closer to $19.5 billion.
Okay, so guiding below expectations. That never goes down well.
Rarely. So you had the AWS growth compared to rivals, and then the slightly weaker than hoped for forecast. That combination seemed to trigger the sell-off.
And we keep coming back to these huge investments, the CapEx, driving down that free cash flow. Let's really dig into that now. Why is this aggressive CapEx, as the sources put it, such a big deal? And what sort of numbers are we actually talking about?
Well, the numbers are pretty staggering, honestly. In Q2 alone, just that one quarter, Amazon spent $31.4 billion on capital expenditures.
$31 billion in 3 months.
Yep. And the projection for the full year, somewhere in the range of $118 billion to $120 billion.
Oh, wow. That's enormous.
It really is. And this isn't just, routine spending. The sources frame it as a strategic gamble, basically, pouring money into AI and cloud infrastructure for future dominance.
But the risk is?
The risk, as highlighted, is that this aggressive spending hurts cash generation and profit margins now, which, as we saw, links directly back to that massive free cash flow slump. The market sees the immediate hit.
So it's this tension between investing heavily for the future, maybe sacrificing short-term cash, versus keeping the market happy right now.
Exactly. That's the tightrope they're walking.
That is a lot of money being poured back in. Almost the GDP of a small country, like you said. When you see that kind of spending, does it make you question the immediate returns, or is it really just a necessary cost for Amazon's long game?
That's the multi-billion-dollar question, isn't it?
It brings us to an interesting point. What are the actual financial analysts saying, the ones who cover the stock day in, day out? Are they as worried as that initial 8% drop suggests, or do they see a different picture?
Well, here's where it gets really interesting. There's quite a contrast.
Oh, yeah.
Yeah. Analysts, generally speaking, remain surprisingly upbeat, actually, despite that stock drop.
Really? So they weren't spooked?
It seems not as much as the immediate market reaction. You had big firms like UBS, Bank of America, Jefferies, Morgan Stanley. They all came out and basically reaffirmed their buy ratings.
Okay.
And many of them actually lifted their price targets for the stock, some targets going up into the $265 to even over $300 range.
Wow. So they're seeing significant upside even after this report. What's their reasoning? How do they justify that optimism given the AWS lag in the spending?
Their reasoning tends to focus on the longer-term picture. They cite the continued strength in retail, which we talked about, the booming advertising business.
Right.
They also mention things like Project Kuiper, that's Amazon's satellite internet project. And they point to evidence of growing AWS orders or backlog, suggesting future revenue is still lining up, even if current growth is slower than rivals.
So they're looking past the immediate quarter's growth rate comparison.
Essentially, yes. They seem to be betting on Amazon's sheer scale, its global reach, the powerful e-commerce and logistics network. Things competitors just can't easily replicate.
The moat around the business.
Exactly. They believe that moat is deep enough to handle these investment cycles and competitive pressures. They see the long-term fundamentals in cloud, logistics, ads, still supporting significant value, even acknowledging the immediate cloud concerns.
So we have this clear tension then, a sharp, maybe short-term market reaction driven by the cloud lag and the guidance versus these more optimistic long-term analyst views banking on fundamentals and future growth from these big investments.
That's the core dynamic right now. What's fascinating here is just that divergence between the immediate sentiment and the longer-term strategic views.
So what does this all mean if you had to boil it down for Amazon's overall strategy and their path forward?
Let's try and bring it all together for the bottom line then.
Okay, let's do the summary. The good, the bad, and the ugly synthesized.
Okay. So Amazon delivered, fundamentally a solid quarter. Growth was strong across most core areas. Retail, subscriptions, advertising, even AWS revenue itself beat expectations. That's the good.
Right.
BUT. And it's a significant but. AWS growth clearly lagged behind Microsoft and Google in this really crucial AI acceleration phase. That's the bad.
Got it.
And then those soaring capital investments, that huge CapEx spend, took a massive bite out of free cash flow and put some pressure on margins. Combined with the slightly soft Q3 guidance, the spooked investors, triggering that sharp stock drop that's the ugly.
Okay. Good, bad, ugly, clear.
Yet, through all that, the analysts, for the most part, are keeping the faith. They maintain their long-term bullishness, seeing Amazon as structurally sound and making necessary, if painful, investments for the future.
So putting it all together, what's the ultimate challenge, the key test for Amazon now, based on everything we've discussed?
I think the crucial test for Amazon moving forward is this. They have to prove that AWS can scale faster, can compete more aggressively, especially in generative AI, to really justify this incredibly high capital expenditure strategy they're pursuing.
That's the nut they have to crack.
That really feels like the core challenge in the coming quarters. Can AWS reaccelerate in the AI era?
And there you have it. A company clearly firing on several cylinders, retail, ads, but facing this absolutely pivotal moment in its biggest profit engine, AWS, while managing this enormous spending spree.
A complex picture, for sure.
It leaves us with a lot to think about. As you, our listener, consider Amazon's massive capital investments, how do you think they'll balance that need for rapid AI build-out with the very real pressure on cash flow and margins?
Yeah, it's a tough balancing act.
And what do you think is ultimately the more important signal for Amazon's future right now? Is it that strong retail and advertising performance? Or is it the lagging cloud growth and that heavy spending?
Worth pondering.
Definitely keep a close eye on those AWS growth rates in the next few quarters. That's going to be a key indicator, probably the key indicator of whether this huge bet they're making is starting to pay off.
Couldn't agree more.
Until next time, keep digging deep.